Tuesday morning, welcome back to Squawk Box Asia side. Quick snapshot. Here's how it's shaping up. A little bit soft. Tokyo's down 0.5%. Korea is off 1/3 of 1%. Sydney 0.6 behind, and New Zealand 0.7 down after some give back on Wall Street overnight. Let's get to Dr. Andrew Freris, a senior investment strategist at BNP Paribas Wealth Management, joining us live from his trading floor up in Hong Kong. Dr. Freris, always good to see you, and a pleasure having you back on the show. You've been doing some work on this whole issue of deflation. You've got a slightly different definition, though. Lay it out for us.
Well, you know, if you cannot find something to worry, then the markets will find something. And of course, we had the issue of deflation. And deflation meaning, of course, whatever you want it to mean, whether it is negative inflation or very low inflation, two completely different things. United States has touched the minuses. Japan has been registered minus inflation. I prefer year to year rather than a month to month numbers if this is going to give me the feel of the overall spread. But I think the likelihood that we're going to have deflation as a kind of a permanent problem for the next 12 months is rapidly receding, not because the economies are doing very well, but because of the colossal amount of monetary stabilization and reinflation policies that at least the G3 economies are undertaking, both in terms of fiscal initiatives, which are in a sense inflationary, they increase aggregate demand. And therefore, I'm not particularly concerned that we're going to stay through a period of sustained headline negative inflation. Low inflation, yeah, it is by far. And of course, that might have a little sort of tweak at the end of its tail, so to speak, because it's not going to help long-term bond yields. And I'm not suggesting for one moment that the recent upsurge we have seen, again, the 10 years are nearly within kissing distance from 3% is because of inflation fears, but this is not going to help. And also, of course, the recent very significant falls in the price of gold might just find a flaw as investors, again, begin to refocus that the problem might very well be much further down the line, perhaps 2 years down the line, inflation rather than deflation.
Interesting stuff. Let's talk about gold very quickly. The floor, where might that be, do you think?
Well, the gold that in this cycle hit the top at about 1100, and I imagine not lower than 800 will be a sort of a reasonable suggestion. Actually, I'm seeing gold on a medium term at about 950. In other words, in the next 6 months, I don't see it hitting again its top, but sort of, falling down to 880 and 860 as it has been doing recently, precisely because the investors said, hey, we're out of the recession. We are now willing to take more risks. And guess what happened? The stock market yesterday fell again. Thank you.
Andrew, what about
I'm not being sarcastic here.
I just want to stay with this theme of gold. It is interesting, especially last week when we heard about the IMF gold sales plan to help fund the G20 initiatives. Do you think that's a factor that's going to pressure or continue to pressure the gold price, or not, as the case may be, since the IMF clearly very cognizant of the fact that if they just release the gold for some 400 tons into the marketplace, is going to cause some pretty widespread disruption. So it's going to be in a phased process. So given that, is it really going to cause much disruption to the downside?
I'm afraid I don't think so, actually, because, oh God, this is going to be incredibly boring. When one looks at the details of what the IMF is likely to do, most definitely any of its sales, which is, they're talking about 400 tons, will be backed up by actually purchases by national banks. And in fact, looking at some BIS and IMF numbers, actually a surprising number of central banks have been actually adding to their gold reserves. So initially, when they said, we're going to finance the recovery plan by selling IMF gold, I thought, but then when one reads the details, it's not the same thing at all. And also, of course, there is the central bank agreement on the sales of gold, which is coming up for renewal on September the 26th. And I think this is also going to provide some kind of a stabilization. In other words, the last thing they're going to do now is to come and say, we're going to flood the market with gold. I don't think that's at all to their interest.
Mark, first, I got to ask you here, and Rosie, it might be useful for viewers and for us as we continue talking about this to throw up the 10-year Treasury chart. Just tucked under 3%, even though we've had at least 2 rounds of the Fed coming in to buy paper. So it doesn't seem to be working too well, Dr. Freris, although, we'll have to see how it plays out. But you're saying because of this whole deflation issue that you've been trying to explain, we could have 10-year yields up at 3.5% by the first quarter of next year. This goes totally counter to what the Fed is trying to achieve, does it not?
We can split it up in three sections. One is the U.S. government will need to issue another $1 trillion. They've just started. The Fed has said they will buy up to $300 billion. So effectively, somebody will have to buy the other $700 billion of U.S. treasuries. And if it is, in fact, the market in the United States, it's going to elbow out all other lenders that are trying, in fact, presumably, are trying to borrow. And this is precisely what the Fed would like to help. Now, the other two big purchases is Bank of Japan and People's Bank of China. And, of course, whether they will be willing and able to buy will depend, of course, what's going to happen to their current account surpluses. And these are shrinking. So whichever way you're going to look at it, if the Fed buys up completely, the whole lot, and I'm exaggerating now, this is going to be hugely inflationary, and that's going to push the yields up.
Odd situation,
it's not just a dangerous kind of forecast to make. You know?
Yeah. Okay.
I think it's pretty safe.
Okay. Listen, Dr. Freris, hold that thought. We'll come back and talk more in just a bit. Dr. Andrew Freris from BNP Paribas Wealth Management. Get back in from his trading floor in Hong Kong in just a while.